Between fast-changing tariffs and turbulence in the tech sector, I mean, the stock market really has been through it recently. It's been very shaky, and there are some recession concerns growing here. So, of course, joining us this morning is local financial expert Matt Eilers from Medalist Wealth Management with advice on how to manage these market swings. Yeah, I've been paying attention. Sometimes we feel like we're way in the green on the stock market.
Yeah.
Sometimes it looks like we're tanking a little bit.
Yeah.
So what is with the stock market volatility right now? And, I mean, what should people be paying attention to?
Absolutely. So the first thing I think that we should talk about is what is volatility?
Yeah.
Because it's a word you hear and some people don't even know what that means. But think of it as if you were about to jump into a swimming pool. It's to the degree of choppiness that's going on in there. So when volatility is high, it's the huge ups and the downs of the water. When volatility is low, it's more smooth sailing. So a little bit more stressful situations when volatility is high. But here, very simply, what's been really pushing volatility in the wrong direction, the uncomfortable direction, are the markets and the uncertainty.
Okay.
And if you think about it, I think I've mentioned this before when we visited, the markets are a lot like a high schooler. They're very emotional and they tend to overreact. And with all of the uncertainty around the tariffs, that has really kicked in a ton of volatility, which has led to huge, downturns and huge upturns as well. And so I actually grabbed some data this morning just to give the viewers a little bit of perspective of what a wild ride this has been. So if we look at the three major market indexes, the S&P 500, the Dow, and the NASDAQ, at one point the S&P 500 was down 15% this year.
Wow.
Year to date. And as we sit this morning, it's up a little bit. So you think about that huge downturn and then the huge recovery. The Dow Jones was down about 10%, and now it's only down about 1%.
Okay.
So it's had a huge rebound as well.
Interesting that so many different factors are at play, right? I mean, like the international markets in and of itself can kind of be a factor, but also, to your point, headlines, when they come out, that does tend to draw things one way or the other. And so I'm curious, in your opinion, what is the main driver of things that we're seeing here? Is it the tariffs, or are they different policies that we're seeing across governments here?
It's a mixture of everything, Tanner. So definitely the tariffs. The markets have been starving for certainty. And, we saw what happened as soon as we started to get a little bit of clarity on, the China situation and what that did to the markets already. But it's been a wild ride, which is why having a plan to ride it out is so important for investors.
We'll get to that plan, but of course, I want people to understand, though, the things to pay attention to. So we've given it a little context. What are some of the indicators that we should be watching over the next couple of months as we head into summer?
I boil it down to three things that I actually made some note of here to share with the viewers about where they are today. But you want to look at interest rates, you want to look at volatility, and you want to look at inflation. So from an interest rate perspective, every time we see the headlines about how the Fed is going to speak and are they going to lower something, that's going to be an indicator that can affect things. So as interest rates move, that can affect the markets. And right now we're pretty much holding. The Fed's not done anything there. Inflation, which is the consumer price index, I looked up this morning. So yesterday inflation decreased last month a little bit, which was a big deal for the second time this year. So that went from 2.4 to 2.3%. And then volatility. So a good measurement of the choppiness of the waters is something called the VIX, the VIX index.
Interesting.
And when you can look at that number, we're actually below 20 now. I think it's in the 18s as of this morning. That is a really good indicator of, really how rough the ride would be on that roller coaster.
Okay, and what does that measure exactly?
It measures really the extremes of the up and downs. It's kind of a measurement of how severe things have been, and there's a lot of things that are factored into that. But the ups and the downs of those indexes are going to lead to a higher VIX index.
Okay.
So in which it can be a really good indicator when volatility is high. That could be a good entry point to buy in to the market, because a lot of the times you could be buying something on a major dip.
Okay, interesting. That's something to keep in mind. If you're the everyday investor, what is something that you can do to kind of manage the risks with this volatile market? I know you kind of gave us the tools to look out for. What are some things that we can do to help kind of mitigate any risks there?
Yeah, it's going to boil down to three things. And we're going to get into these just for a moment, but having a plan and sticking to it.
Okay.
Diversifying and working with a professional. So to stick to a plan, you have to have a plan. And a lot of the times, we need a plan for the proper risk tolerance. So for an investor to know that they're taking the right amount of risk during times like this is really, really important. And to make sure that their investment portfolio aligns with their actual risk tolerance. That's a big deal. So having that plan for knowing what you own, why you own it, and what needs to happen in the markets for you to make a change or a decision. And the biggest thing that I like to tell our clients or people that we visit with is to try and take emotion out of it. Emotion is one of the biggest killers of successfully buying low and selling high, which is what we all want to do. Emotion leads people to, sell high, or excuse me, to buy high and sell low, the opposite. So we want to remove that emotion as much as possible, and that's what a plan can do. Diversification is a big deal.
Yeah, and that was actually my next question, the value of it. It seems very important for that to happen, especially right now.
Yeah, it really is. So when we say diversification, it's how your assets are spread out amongst different asset classes. And depending on like where you're at in your financial life, different levels of diversification are important. So, young fellas like you and I, we're probably gonna have a lot more diversification to equity markets. So stocks and mutual funds and ETFs and things of that nature. Someone that maybe is looking to retire in 5 years or is already retired, they're not gonna have as much exposure, they probably shouldn't, based on their risk. So having a diversification amongst the markets, amongst real estate, if you're retired, other vehicles like annuities or insurance products is really important. And that's where all of those things really need to fit into that plan that we talked about that investors need to stick to.
Yeah.
And then that third thing is, working with a professional.
Yeah.
There's so much benefit, especially in times like this, to partnering with somebody that does this for a living. Fidelity put out a study that actually showed that investors working with professionals netted a little bit more than 5% more in returns than trying to do it themselves. So the professional can help you formulate the plan, but most importantly, during times like this and this year, they can help you stick to it.
Okay, well, at what point should we be considering a financial expert? Is there a point where we're looking at our portfolio and we're like, all right, we need to start talking to somebody? What is that point?
I think the point is when you are ready to make a financial decision. If you have assets you're trying to save, or whether it's you're trying to get out of debt, pay off student loans, save for retirement, figure out how to invest into your company-sponsored retirement plan, seek out the help of a professional. That's what we're around for. For people that don't want to try and do it themselves, they don't want to have the level of talent, temperament, or the time to invest, that's where a professional can come into the picture to really take those things off of your plate. Professional advice comes in all shapes and sizes to investors of all shapes and sizes.
Okay,
really.
I've got two more questions for you, and not a whole lot of time. So I want to talk about the potential of a recession. We've heard that word thrown around over the last couple of months, right? In your professional opinion, where are we at with that? Do you think that we are headed toward that trajectory, or maybe should we not worry about that just yet?
My Matt Eilers' professional speculation, I don't think that we're headed for a recession. I believe the economy is strong. There's a lot of underlying indicators that tell us that. Jobs are strong, earnings are coming up, the housing market is strong. I just pulled numbers this morning from kind of the three big banks, Goldman Sachs, JP Morgan, and Barclays, that they also indicate levels of recession probability. Goldman Sachs has decreased their probability of recession from 45 to 35%. JP Morgan was originally at 60%, now they're below 50, and Barclays has completely dismissed the possibility of recession this year. So, for consumers that don't want to track all the things that professionals track, you can look to the news and look to some of those big three that put that out there. But I think that the economy is up for a big boom this year in 2025.
All right, let's talk one more thing. I know we've got to go here in just a few seconds, so I'll give you 30 seconds to answer this question. If you had one thing to look out for, all across the financial landscape, what do you think is the one thing people should be paying attention to right now?
Right now, I think people should be paying attention to volatility, and I'm going to say volatility and inflation.
Okay.
Those are kind of the two indicators that are really going to steer things. The Fed has a finger on this with the interest rate environment, but those are a couple good things to keep an eye out for.
All right, Matt Eilers with Medalist Wealth. We appreciate your time as always. We'll see you next month.